everybody. Welcome to Sounding Board. This is our first episode that Becky and I are recording today to talk about hot topics in accounting and finance and audit in the factoring space. Again, my name's Claudia Montalbano, and I'm an accountant in the space. And Becky.
Yeah, I'm Becky Gibbs. I'm a partner at Boyum and Barenscheer.
So we're going to delve into the topic today of bad debt reserve, which Becky has told me is no longer called bad debt reserve. It is now I call it CECL. I don't even know the acronym spelled out.
Current expected credit losses.
It's all the same. So we're going to talk about technical aspects and maybe some practical applications for smaller factors and how it all works. So Becky, could you give us a brief overview on the technical aspects of CECL?
Yeah, so like Claudia mentioned, it's no longer called bad debt reserve. Granted, I know a lot of people still just call that on their P&L, bad debts. That's all right, but it's now called current expected credit losses. So what that means is that you are looking at not only what your receivables are and the risk of non-collection that you have, but also taking in consideration other factors that might be happening within your industry that you're working in, economic factors, say a recession, or is it a booming time? Those types of things that can all come into play, not just your historical, what you've known has happened within your business. So the current expected credit loss, the standard that came out, I think it was about 2 years ago now, it wants you to really dive deeper into it. And I think why this came into effect is because of the banking industry. There are certain industries that usually kind of trigger why they change accounting standards. So what they want you to do is embrace looking at your receivables and what could be at risk for you.
Actually assessing it, not just coasting
Right. And
or applying a blanket
yep.
and going with it forever.
Yeah, exactly. Because I know I have clients that just put 10. That's what it's always been for the last 20 years. And obviously, there's been bad debts of 25 that can happen in a year, and years there's 0. So really taking into consideration some of those factors. It is asking you to look at it based on some income statement approach. So meaning you're looking at it on different buckets is what I'll call it. So are you looking at it at your aging buckets? Are you looking at it based on your industry lines of where your client base is at? Those type of things, and then applying percentages to those buckets of what your allowance will be.
I like that approach. I mean, it makes a lot of sense, I think, for factoring companies, since what we're lending on is the receivable. So if you take a look at your aging, and see what's happening there, it makes sense. So if you're looking at the different aging buckets, 0 to 60, 61, to actually 0 to 30, then 31 to 60, and so on and so forth. Would you be applying different percentages to each bucket? I mean, obviously over 90 is going to be viewed a little more risky than under 30. So is that a valid approach?
That's a valid approach. What I would say is one of the easier ways to approach doing a reserve too of, all right, so anything over 90, maybe that's a 2-3%, maybe up to 10, maybe up to 50. It could really vary depending on what your business is like and how your collections are.
Yeah.
And then 0 to 30, maybe that's 0% or 0.1%, just because those are all current and there isn't as much risk there. Especially the factoring space too. Even if you don't want to look at it on a bucket, you could look at it based on who are you factoring with? Is it just transportation? Then maybe that is one bucket because the risk within transportation is kind of all similar, where maybe you were within transportation, but also healthcare and construction. There's different buckets.
It's a lot riskier than all the above, and so then maybe you reserve a little more, right?
Yep.
So you really just need to look at your portfolio, like pick a method, and then apply what's happening in your portfolio also to that method.
Yeah. So embracing it. But to add a little flavor to it too, they came out with some new ways you can approach this standard from 2 years ago also. So there is now what we call a practical expedient, and that allows you to just use one rate across your whole receivable balance.
But that really doesn't do you any good, does it? Because in the end, don't you want to reserve what you really think is, I mean, I know plenty of company owners who just kind of want to keep it as is and you don't want to change anything. But I think if you're really thinking about it, what's best for the business, having
A
risk
risk-based approach.
assessment, yeah, on each of your larger clients, I guess, the portfolio as a whole.
Yeah, and usually what happens when they apply these practical expedients, it's available for small companies, so meaning that you're not publicly traded.
And that's a really good point, though, too. Because a smaller company only has so much resource and time to allocate to something like this.
Yeah, and I mean, factoring's different. There is a little bit of a risk there, but say you are a manufacturing company and you only work with Fortune 500 companies, you're likely having a pretty low risk on your receivables because those are pretty guaranteed businesses that you work with.
Yeah.
That's where that rate, where you could just have a one rate approach.
Would you ever look at a company and see maybe some checks and balances or process issues and say to them, because of the way you're handling your back office, we think that you have receivables that are more at risk and you need more reserve? Would you ever say that to a company? Or
I
have
have
you?
I
Yeah.
have said it to a company.
Yep. So that comes into play too.
It does, and usually when we're coming into play too, it could be a few weeks to a few months after year end. So we'll look at subsequent collections to see what of that receivable balance hasn't been collected, and then we might push back further. If a lot has not been collected, that rate should probably change. And
Yeah.
there is an accounting policy that allows you to do that too. If it is, say you do collect everything by the time you do audit field work, we can
Yeah.
get away with having a lower reserve, but if
Yeah.
you don't collect, then there should be a higher.
Yeah, makes sense. And I think we both know from being in the space for a little while, there is an inherent risk of fraud that we don't even know about, too. Do you want to allocate something for that, right? I mean, is that a legitimate way to calculate it as well?
I think that's what the CECL model is telling you to embrace, right? Because I mean, there's probably a fraud webinar that you could go to every day talking about the risks out there. So even if you have that consistent customer that you've been working with and collecting, they could pull something on you at any point,
Absolutely.
and that whole receivable goes away on you.
Yeah. So it's not as cut and dry as some companies I think look at it. But anyways,
When you're doing your consulting, just being within the business on a day-to-day, month-to-month, how do you approach it with your clients?
yeah, I think especially smaller clients, but really larger clients too, any like giant swings on the financial, we kind of like to look at it and say everything was consistent each month. Not that it has to be, but bad debt reserve is it's not something that's happening in reality, right? It's something that is,
It's a non-cash, yeah.
yes, it's an estimate. So what I like to do is apply just a general percentage, a small percentage to the monthly purchases that accrues each month. And then depending on the size of the company, maybe evaluate it on a deeper level, the deeper level we were referring to earlier in our conversation, based on industry, based on, receivable buckets, things like that, either on a quarterly basis or just at year end and do a year end true up. So unless something major happens during the year. So at one point when I worked at a much larger factoring company, we had a specific reserve and then we had a general reserve. So if we had a list of collect out clients, we were evaluating those for a very specific reserve amount at year end. And then you would have a general reserve for the rest of the portfolio because there's some kind of inherent, risk within the rest of the portfolio as well. So that's kind of how the different approaches that I've done throughout the years. So I think it's consistency. There's picking, a way to view it, choosing a way to view it, and then being consistent in your process with it.
Yeah, and you're looking at it on a month-to-month basis from a P&L perspective too, is what you're saying, to get that consistent expense side of it all. Where, like myself as an auditor, I'm going to be looking at it on an annual basis to see what of those receivables on the balance sheet are legitimate.
And that's what I tell my audited clients. I say we want to kind of have a realistic approach to it on a month to month basis, but really during audit, all you guys are going to look at is what's happening on a year to date basis. As long as we'll be able to address it at year end for the year in its entirety, I know that you will be satisfied,
Bracing the standard.
which will probably change again next year.
Well, we have to keep ourselves employed, right? It's always changing. Yeah. Well, this was a great discussion, Claudia. I think we covered a lot of different perspectives on how to approach CECL and how to embrace it and apply it in your business on a day to day.
Yes.
So, yeah, thank you for joining us on Sounding Board. We will continue to have various topics that we discuss. If you have any topics for us, please reach out to us and let us know.
And feel free to contact us if you have any questions on what we've discussed or anything else. Would love to hear from you.